This is actually the first of 4 live events that I'm going to be hosting around managing your credit, because I want you to have power over your credit, not be overpowered by it. And we do this by understanding the difference between good credit and bad credit, and also making the most of the finance that we can access, hopefully mostly the good credit. So this series is part of a campaign by Capitec called, and you will see it there, Living Better Starts With whatever it is your goal is. So your goal could be buying a home. We're going to be talking about home loans today. It could be about paying off your car. It could be about closing your credit card, for example. Whatever that goal is, I want you to share that with me in the comment box today. In fact, I must make sure I've got my little comment box open so I can keep track of all of your comments. And I want you to share it with me because there are prizes to be won. So not only am I going to be giving away a copy of my book at each live event. Let me see, there you go. It's My Money, My Money Questions Answered. So this book was really written with all of my followers in mind, because all of you who send me questions, I land up writing about them and I answer them, and it's in this book. So I'm going to be giving away a copy of this to somebody today. But not only that, there is also a grand prize to win. So over this month of the Living Better Starts With campaign, Capitec is sponsoring a 10,000 Rand prize to one lucky person, and that can go towards the goal that they've identified. And there's a one-on-one session with me. Now, this is actually quite an unusual prize, because if any of you have ever approached me, you'll know that I don't do one-on-one sessions. I just cannot fit it into my chaotic life and schedule. But I am going to be able to spend an hour with one of you and help you reach that goal, along with that 10,000 Rand from Capitec. So to stand to win that grand prize, there's a couple of things you need to do. You need to watch these events and make sure we're tracking you, so we'll know if you've been in all of them. We need you to share your goals on social media. You can do it on the Facebook page, on Twitter, Instagram, wherever it is, but make sure you use the hashtag Living Better Starts With, and make sure that you include my handle, Maya on Money, so we know that you're part of my campaign. You also need to sign up for the Capitec Credit Bootcamp series of emails. You're going to get the little link is going to be posted on the Facebook page now, so please make sure you keep up with that. This is a series of articles that Capitec has put together to try and help educate people about making good choices and healthy choices around credit. So hopefully that all that's inspired you all, and I hope one of you are going to be the lucky winner of that 10,000 Rand. But now on to the topic of the day. We're going to be talking a little bit about home loans. But before I start on that, I really have positioned these series of discussions around understanding good debt versus bad debt. And people always say to me, Maya, what is good debt and what is bad debt? For me, good credit, healthy credit, is credit that you take on to achieve something that's going to move you forward in life. So a home loan would be a really good example of that. This is a home, it's going to put a roof over your head. It's also an asset, it will grow with value. It could be an investment for you if you rented it out. It's going to bring wealth to you. A car literally moves you forward, so a car may be something that you need to get to work, to fit your kids, to take them to school, all of those things. In South Africa, we don't have a great transport system. So yes, I would say a car falls under good credit. But a car that gets you from A to B is good credit. A car that is a lifestyle choice and a statement to your friends and puts you under financial pressure, that is not good credit. For me, it's also about how much you spend on the car and the affordability that would fall under my good and bad debts. Another good example of good debt would be student loan. Going and studying, learning, educating yourself, putting yourself in positions to get a better job, to earn more money, even starting a business. Those are good credits, and we're going to be really discussing this over the next couple of weeks about how to engage with that sort of credit and how to make really good choices around it. But today it's going to be about home loans. And the reason I wanted to kick off with home loans is twofold. One, it's one of the most common questions I get from people. In fact, I've written quite a lot of articles about it quite recently, simply because we're getting so many questions about it. But the second reason is that Capitec actually launched its home loan offering today, I think, or yesterday. So I thought it would kind of tie in quite nicely, seeing as this is part of their campaign. So when I look at home loans, one of the things that I find, if I have to say the mistakes people make, is that most people are not ready for the true cost of home ownership. Because to owning a home, buying a home, the costs, the transaction costs, and then the ongoing expenses of running the home, it can become really, really significant. And I want to share with you a slide here quickly, just to give you an idea of the kinds of costs that you can incur when you buy a home for the first time. I'm on the wrong, this is going to give away my next one, but it's fine. I'm going to quickly skip up. Don't look at that too much, because we're going to talk about that a little bit later. Oh, this would happen, of course. There we go. This is what I wanted to show you. This is the graph I wanted to show you. So this is an example of a transaction costs on R1 million sectional title property. The costs to buy the house is about 53,000 Rand. 53,000 Rand. I don't think most people actually realize that. Most of it, by the way, goes to lawyers, bond registration costs, and property transfer costs. I'm not even talking about transfer duty, because that's actually not a problem at R1 million. It only affects you afterwards. So you need to have at least 54,000 Rand over and above the deposit that you would be wanting to put down. So you kind of need a war chest, I would say. If you want to put a 10% deposit down on your house, which you often need, the banks often require that, plus cover all these transaction costs, you need around 15%, maybe even 20% of the value of your purchase before you can consider buying a home. And then there's the ongoing running costs. Let me tell you, if you've never owned a home before, it is a shocker. All right, you can pretty much, your mortgage is one thing, but your building insurance, household insurance, rates, levies, water, electricity, maintenance, and let me tell you, those rates, electricity and water, are going up at a rapid rate. I mean, it does depend where you live at the moment as to what your rates are, but I am getting so many complaints from people about rates, especially older people. They've lived in the house for so many years, and suddenly the rates have just escalated, and they actually can't afford to keep the home anymore. So these are big running costs. I would say, if your mortgage is 8,000 Rand, expect at least another 4,000 Rand. So 50% of your mortgage, add that to the running costs, and understand that this is actually what it costs to start owning a home. So owning a home is not just something you wake up tomorrow morning, you see a nice house, you say, let me go for it. It does require a plan. And I want to share with you a kind of strategy that I always follow. And that is what I always advise to people. I say to them, if you're wanting to buy a home and you're wanting to become a homeowner, rather live like a homeowner before you buy. So what I mean by that is, go find out, what will that mortgage cost me? What will my rates, electricity, all of those things cost me versus what I'm spending at the moment? If you're living at home, of course, at the moment with your parents or something, brilliant, because you can save a lot of money. And start living like the homeowner. Start living as if you are already in the home. By what I mean by that is, whatever that cost difference is, start saving it. Start putting it out of your account at the beginning of the month and start putting it away. If you find you cannot do that, you're not ready for that home. So it really does stress test your budget before you commit. But it also does two other fantastic things. First of all, you save towards your deposit by doing that. Okay, so you can put down that 10% deposit plus all the extras you need for the transaction costs. But it also makes you're able now to go to the bank and say to the bank, I have lived as a homeowner. I understand the cost of home ownership. I can afford this, and you're likely to get a much better interest rate and definitely qualify for that home loan. So I think that for me is really the main tip that I want to give you today around if you are looking at purchasing a home. So don't just rush into it. Have a plan. And the other thing that I'm picking up at the moment, another big question I'm getting is this the right time to buy property? Because, of course, we've had this massive rate cut. I mean, prime rate was 10% at the beginning of the year. It's now at 7%. So it's effectively a 30% decrease in the cost of credit. This is suddenly making home ownership a lot more affordable for people who are starting to say, well, hold on, my mortgage is going to be quite similar to the rent I'm paying. So I want to just give you a little bit of word of warning. These rates are not here to last. We are at the bottom of an interest rate cycle, which means that maybe there'll be another cut if things get worse. But most economists are expecting us to increase interest rates in about 2 years' time. It'll be gradual. It's not going to jump back up by 3%, but it will be gradual. So if you are buying now, you need to buy understanding that you're going to have to tolerate rate hikes. We can perhaps in the Q&A, if anyone wants to understand, we can get into discussion about fixed and variable rates, but you need to know that you can afford to accommodate future rate increases. So what I would do if I was buying a house now is I would say, find out what would my mortgage be if it went back to the interest rates it was in January. So if we went back up to 10%. And if I can afford that now, why don't I start right from the beginning paying extra into my mortgage? Because it does two things. It makes sure that when those rate hikes start, I can afford it. And secondly, it helps me pay off my mortgage sooner. Exactly the same thing applies if you are already a homeowner. If you've been owning a home for a couple of years, you saw and you can afford it. Of course, I'm now assuming that you can afford this. You haven't been hit by the COVID cuts in pay. But if you can afford it, try and keep your repayments the same as they were in January, because it will keep your budget, bulletproof your budget from future rate cuts, but also it will help you pay off your mortgage earlier. So what I'm going to do is I'm going to now share with you 2 slides. I'm going to take you through this. This is a little technical, but I really want to spend time on this because it is something people really don't understand. And this is amortization and why paying extra into your mortgage has such a massive impact. So because we don't always understand the way our home loans are structured. So in this example, okay, so I've got an example here of a home loan. This is a R1 million home loan over 20 years with an interest rate of 8%. You will see, so I see there's a mistake here. It says annual repayment. It's actually monthly repayment. So in month 1, your mortgage, look at that. Each month, your mortgage is exactly the same. Every month, it's 8,364 Rand. It is identical sorry, that's going the wrong way. Every single, my mouse is misbehaving. Every single month, you pay exactly the same amount of repayment. That's your monthly repayment. What is not the same is what goes to interest and capital. That is what varies every month. And that is what we talk about amortization, the way that this amortization works. So in your first month, remember you started off with R1 million. On that, 6,666 Rand of your 8,300 goes to interest. A tiny little 1,697 Rand goes to capital. So your balance at the end of that month only reduces by the amount of capital you're paying in. So you're barely off R1 million. By month 60, so if you have a look at month 60, which is about 5 years into your home loan, you will see that you are still paying significantly more interest than you are capital. So most of it's going to interest, because by this stage, your balance has come down to about 875,000 Rand, but the interest charge on that is 5,800 Rand. So what's left from your mortgage, monthly mortgage payment is only 2,500 towards capital. It is only in month 136, which is about 11 years into your mortgage, that your interest and capital are actually equal, that you're paying an equal amount into interest and an equal amount into capital. And that's, your balance has now come down to 626,000. And then the last month, this is the month before you pay off. This is 239 months in. You will see that very little goes to interest because your balance is now being reduced to 8,300. So most of it goes to capital. And that's what we talk about when we talk about amortization. So now you can understand why it feels like in the first 5 years, especially, you're getting nowhere. You've paid in all of these installments, and yet it's just inching down bit by bit by bit because so little is actually going to capital. So what happens if you pay extra? In this example, I've just said, what if you increased your payment just by 10%? So on this example, of course, you would have, because your mortgage was 8,300 odd, you'd pay an extra 836 Rand, which means that your monthly mortgage, not annual, monthly mortgage repayment would be 9,200. So you're paying in more than the bank wants you to. So remember, in the first month, on the million Rand, your interest will be the same, but you're paying that little bit extra into capital. So at the end of that first month, instead of your balance being 998,000, it's already starting to drop by that additional payment that you put in, because every Rand of extra payment you put in goes straight to reducing that outstanding balance. In month 60, so we're 5 years in, you're paying interest, you'll still have interest, but you're paying in a lot more capital. If you can remember, you were only paying in 2,500 Rand capital, now 3,700 is going to capital. And look at the impact. So if you were not paying an extra, your balance would only be 875,000, but already it's starting to come down a lot quicker, 813,000. So you may still feel after 5 years it's not coming down that quickly, but it really, really starts to work with you over time, because by that month 136, remember the repayments were about 4,000 into each. Here, you're paying only 3,000 into interest and over 6,000 Rand into capital. And look at the impact that's now having. So by year 11, if you were not paying an extra, your balance would only be 626,000 Rand. But because you've been paying an extra, you've already paid down and you only owe the bank 441,000 Rand. So what happens? By month 194, which is about 16 years, just around 16 years of your bond, you're actually paid off. So in that year, had you not paid extra, you would still have a balance of 330,000. Instead, you are about to pay it off with your last installment. So that means you pay off your bond just by paying an extra 10%. You pay your bond off 4 years earlier and you save a massive 214,000 Rand in interest. So I hope that's kind of helped you guys to understand the difference on why it's so important and why I always talk about the benefits of paying an extra. And it's not about taking every last cent that you have and hitting your mortgage. It's just about committing to that extra 10%.